welcome to another edition of Insights from the PM's Desk. My name is Justin Plouffe. I am Deputy Chief Investment Officer for the Global Credit business here at Carlyle and a Senior Portfolio Manager on Carlyle Tactical Private Credit Fund, or CTAC. So I want to start with the macro environment, which is really a tale of two opposing forces. The first of which is the strong fundamental economy that we find ourselves in. We see revenue growth really strong across the board. We also see strong consumer spending. Consumers are continuing to spend at a persistently high level in durable goods, but also spending on services is coming back to trend line. And in fact, for the first time since we've been tracking it, our US passenger index is above the level that we had in 2019. Hotel occupancy also showing strong results right now. In terms of inflation, we are seeing continued signs of abatement. So the supply-demand gap in durable goods is closing and shipping costs are down really around the world. Now, the other major force in our economy today is the Fed's continued insistence on raising rates. Just a couple hours before recording this, the Fed again raised 75 basis points. And we're now at the point where most market participants are pricing in some sort of recession for 2023. You can see on the right side the real magnitude of this massive rate shock in just the last 12 months. That's affected every part of the economy, but none more so than the real estate market. A 200 basis point increase in 30-year mortgages just over the last 8 weeks, truly a shock to that system. So what are market participants trying to do? Well, they're trying to make sense of these two opposing forces. Every time we have CPI announced or the Fed raises rates, the market goes down. And then when we get a peek into the strength of fundamentals in the economy, when earnings are announced, the market reacts to that going up. This is really the story of market participants right now, trying to balance these two opposing forces as we move into what could be a rockier 2023. So what are we seeing in the private credit markets? Well, first of all, issuance is down. It's been a very long time since we've seen this little issuance in high yield bonds and leveraged loans, and risk is off. The premium that you get for taking on significant credit risk is much higher than it has been on a historical average basis. This chart shows you that you get over 1,000 basis points of pickup if you're willing to invest in a triple C rated loan rather than a double B rated loan. And then the other big trend we're seeing are the banks unable to offload loans that they underwrote in the first half of this year or before that. Two big deals that were in the market. Nielsen and Citrix. And Nielsen, the banks decided to take down the vast majority of the loans that they had underwritten a year ago. That would have been almost unthinkable. And then Citrix, where the banks did actually sell the loans into the market, but at a significant discount. Carlyle actually participated in both of these deals as a buyer of the loan. We were able to make investments and purchase these loans at rates that we thought were highly, highly attractive for our funds. Now, as many of you know, CTAC has always tried to be tactical in our approach to investing in private credit. Back pre-pandemic, we invested in direct lending when we saw a premium for complexity and illiquidity. As the pandemic hit, we turned away from that part of the market and invested in the more liquid part of the market where we could buy things like leveraged loans and CLO securities at prices that hadn't been so low since the great financial crisis. And then more recently, we've been focused on the opportunistic part of our business where companies come to us for peace of mind capital to shore up their balance sheet with a bespoke capital solution as we move into potentially more difficult economic times in 2023. So what are we doing today? Well, one of the great tools that we have to be tactical in CTAC is to use our leverage. In the first part of the year, yields were not wildly attractive and we thought did not necessarily represent the type of value we should get in a worsening macro environment. The bottom of this slide, you can see that middle market senior secured loans were stuck around kind of a 6% yield. Well, today they're up around 9 to 10%. We think that's a highly attractive entry point. So we have drawn on our leverage facilities, increased our leverage, and purchased into that opportunity. Where else do we see value today? Well, I mentioned before those two big deals, Nielsen and Citrix. Those are liquid leverage buyout loans. We like those at a yield of greater than 10%. On the prior slide, middle market direct lending, if you can get senior secured risk at greater than 10%, we like that as well. And then two more esoteric areas as we move into a rockier 2023, we like structured credit and then special situations. Those are areas where we have core competency at Carlyle, and CTAC will be very well positioned to take advantage of that opportunity as it arises. So before we wrap up, I did want to say congratulations to my colleague, Brian Marcus. Many of you who are invested in CTAC have probably met Brian. He is a portfolio manager on CTAC and also just a critical team member for the entire global credit platform. Brian was recently named a rising star for 2022 by Private Debt Investor magazine. So congratulations, Brian. Very well deserved. That's all for this edition of Insights from the PM's Desk, and we hope to see you next time.